Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Cardinal Health, ticker CAH. And this company is operating in the healthcare providers and services industry. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. Let's dive right on in. So again, this is a $14.5 billion company, $16.9 billion in EV. So we know there's some net debt on the balance sheet. I'm using QuickFS to make this analysis. And for here, you can see that they operate in the integrated healthcare services and products company in the United States, Canada, Europe, and Asia. Pharmaceutical segment distributes branded and generic pharmaceuticals, over-the-counter healthcare, and consumer products. So gives you some idea of where they're operating, providing pharmaceutical devices. It tends to be medicines and things like that. So you have beta 0.83, share turnover 241. Not any of that is super telling. Now, what's interesting when we look at this data is that for 18 straight years from 2002 to 2019, you were profitable and you had pretty good returns on invested capital. There is some cyclicality, but I'd say most years you're earning somewhere in that double-digit range. 8, 9, 10, 11, 12% return on invested capital. Those are good numbers. Those are numbers you like to see. However, in 2018, you had a low of 1.58, 2019, 9%, but 2020 you lost a lot of money, but back to a more normal 7%. Now, because of the leverage that they have in this business, you're seeing that return on invested capital jump from 9% up to a 19% return on equity, which is really what you want to see, because having double-digit return on invested capital is ideal, but you're really trying to get this return on equity above 15% over the long haul. Now, we do see something really weird, and it is happening here with price to equity, or PE and book, both being negative, so suggesting potentially we're losing money. So we're going to have to look into what these numbers are telling us here. You see, earnings per share of 2021 says it's $2 per share. So if we look at the share price, 53, then you're at something like a 26, 27 times earnings, not the 15 that they're showing us. So it's something is weird happening there. When we get to the income statement, we can dive on into that further. Now, if we simply exclude 2020 and 2021, I'd say, because the pandemic is likely playing a factor here, I'd say this is a pretty good high-quality company. You have pretty good numbers. There is some volatility, but even during the cyclical downs like 2010, 2013, 2018, you're not losing money. Now, they did lose money in 2020, but I've been trying to give companies a pass through the pandemic because you really don't know how that played into it. Now, if there's a PE of 15, I think that's a pretty attractive valuation. But again, we're going to have to look into that a little bit deeper. Now, what I do want to see is this revenue growth of 4.7%, asset growth of 6.9%. Because this asset growth is 2% higher than revenue growth, you're going to have decreasing returns over time. And that's generally what you've seen. You have this peak of 17% in 2007. You get down to about 11.59% in 2008. When we roll that forward, you're seeing you're now in that 8% range, 9% range. So even though your highs now are really just topping out there, but you're spending more and more time at lower numbers, like 7% in 2021, 9% in 2019. So you're dropping your return on invested capital because your assets are growing faster than your revenue. The only way you redeem that is if your EPS is growing even faster, but we can see, at least by these numbers, you had $3 of EPS in 2012, $2 of EPS in 2021, so you're still not recovering much faster there. Now, you do get to a peak of $4.53 in 2019, which is really good, but you can see these numbers drop all over the place, and so that's not good for the quality of the company. When you can go from $3 in earnings per share down to $1 and then up to $3 again, that volatility is really bad for long-term compounding. And it makes it hard to rely on certain numbers because the more volatile your earnings are, even if they show a median return here like this, your actual returns over time are going to be much lower due to the volatility. So there is certainly benefits in having a less volatile company. If you're enjoying this video so far, please hit that like button. Your likes are needed to help grow the show's audience. It really shows your appreciation for this video. So if you're liking my videos, give me a like button. If you want to get all the videos I upload going through the entire S&P 500, you need to subscribe. Hit that subscribe button and ring the bell so you can get notified when I upload new videos each and every week. So let's look at the income statement because we really need to digest what the earnings situation here is. And so we can see the difference now that although 2021 reported positive net income of $600 million, you can see that over the trailing 12 months, we have a loss of basically $1 billion. And part of that, though, is you have $2 billion of non-operating income that's negative. Now, you might say, okay, well, can we really rely on that? What is that? But you're seeing this in multiple years. You have presumably write-offs taking place in 2021, 2020, and 2018, and 2017. So these write-offs are taking place a lot. These are a lot of write-downs for a company like this. So it's not like these are one-off things. Now, what we do need to compare, though, is even though on our, let's go back to the overview statement, even though we see some of these years where you have some losses and slower downturns, you do see that every year they do have positive operating profits. So they have some non-operating income issues, but they have positive operating profit every year, and that's really, really good. You like to see that. However, you began the decade with $1.8 billion in operating profit, and you end the decade with $1.8 billion in operating profit. So you're basically flat on operating profit. But something's wrong here because you're flat on operating profit even though you've increased your gross profit by $2 billion. So you've grown a ton on the top line, a ton on the gross profit line. So you're like, revenue's up like 60%, gross profit's up like 40%, but your operating profit's flat. So this shows that this growth in SG&A and growth in operating expenses is really almost a mismanagement of the business, because usually if you grow revenue by 60%, you grow your gross profit by 40%, shareholders should be seeing some return from that, but you don't see any return from this over the period of time. Now, what we do like to see is that you have your shares outstanding declining, which is really good to see. You're growing from 350 million shares outstanding down to 294, so maybe you've retired 15% of your shares outstanding, 15 to 20%. That's a great thing to see, but you still end the decade with lower EPS because of this mismanagement between the gross profit, operating profit, and the net income line. And that's really concerning for shareholders about what could come in the future, because if that continues, it's only going to get worse. The likelihood you're going to continue that growth rate, you already have revenue at $162 billion. That's astronomical. So you really need to understand what's going on there if you're going to be a shareholder of this company. PP&E is not growing up a huge amount. You have a lot of inventories and assets, so that's kind of doubled. And this is, again, part of the problem. You're doubled your current assets. You've doubled your total assets, right? But your income's actually gone down, and that's why you've seen this decline in profitability over time. It's because you're destroying your returns on capital by the fact that you're able to double your assets and not increase your profitability. So major concerns here for what's going on in this business. Cash flow. So not only that, you have about $100 million a year of stock-based compensation. That's pretty regular. Now, they do have buybacks. So they're buying back 4 to 5 times the amount of shares that they issue. So that's why you're still having your shares go down over time. But the concern that I have too is, so again, positive cash flow from operations each and every year. So the concerns for losses isn't really there. It's just showing maybe they're writing down these acquisitions. You see 2.2 billion, 3.6 billion, 5.2 billion. They're growing inorganically, and they're still destroying this capital. So they've grown, how many of these acquisitions? You have 2.3 billion, 2.8 billion, 3.2 billion, 7.8 billion, 8 billion, 13 billion. So they have $13 billion in acquisitions over the course of the last decade, and the value of the company is $14 billion. It's basically completely destroyed the value of all these acquisitions, and that's just what we see from the cash flow. Did they issue any stock from those? No, I don't see that. But they've basically had to create a lot of debt to pay for these acquisitions, and the company's gone nowhere. They've created no value from that. So for me, because of that, because this cash flow, even though you're making positive cash flows, you're not growing your income. And to do that over a course of a decade with this sort of growth in expenses but not growing your earnings is a major concern for me. For that reason, I would pass on Cardinal Health. It's not something that would be interesting for me despite this long history here of what should be good returns on capital. I don't know where they're going. They're certainly not going to shareholders. So for me, I'm out. I wouldn't invest in this company. Pass on valuation, pass on quality. Thank you for listening. Please hit that like button if you're enjoying all my videos. Your likes are the number one thing that help me to grow the show. Without your likes, I can't grow the show. And please subscribe so that you can get more great content as I upload it each and every week. Thank you for listening. And until next time, stop paying fees, start building wealth.